From the morning reading, twice as many calls than puts were traded on stocks in the CBOE exchange on Monday. Over the past 6 months, such low put-call ratios have led to at least a short-term plateau for the S&P 500. Due to the trading range market, extremes in the put-call ratio have been consistent contrary signals. So the current extreme is a negative for stocks here, short-term at least. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:03 a.m. Central Time, and I'm recording this in preparation for the market day, April the 7th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened with our overnight action. Well, looks like it was relatively mixed and didn't go very far in any direction. You have the Russell as the weakest, down about 0.22% as of the time of this cut. The other three indices were all up, but only really quite marginally, with the most bullish being the NASDAQ at up 0.25%. Crude oil continues to have significant overnight volatility, down nearly 1%. The euro was also down about 1%, bonds up just a smidge, and gold down about 2/3%. So the commodity side, that side saw more action than the broad market indices last night. In terms of overseas action, there was quite a bit of action there. China up over 2.5%. Very, very significant move there. China has been on a significant breakout in about the last week or so, and great follow through on that today. Hong Kong up 0.77, Japan up 1.25. Japan's also been an ETF on the move of late, so take a look at that. Germany up about 1%, United Kingdom up about 1.5%. So a very, very strong overnight session for our overseas partners, though it has not been reflected on our own futures markets and the broad market indices as of yet. In terms of macroeconomic reports for today, not much on the slate. For the U.S., we have a JOLTS job openings, which is an orange flag report. But other than that, really very, very, very light. For tomorrow, you've got to, let's see here. I got an FOMC member speaking. We got crude oil inventory, but here's the biggie. And you should be aware of this because it will absolutely affect trading tomorrow. You have FOMC minutes coming out at 2 o'clock Eastern tomorrow. So expect that could very easily have the initial hour or so of trading, and then things probably will go somewhat sideways and quiet in anticipation of those Fed minutes. So that will absolutely impact trading tomorrow. In terms of our current volatility, we continue to see pretty much the same theme with relatively low historical IV percentiles across all four of the broad market indices. Our short-term volatility on the S&P is a 14.16. Nothing really exciting from this aspect. If anything, the thing I would probably draw your attention to is that the VIX is in a daily squeeze, and at some point it's going to exit that squeeze, and almost certainly the market goes down when that happens. But that could take a while. We can stay, as we've seen in the last year or so, where the VIX can stay in a compression for quite an extended period of time before that volatility finally breaks out. In terms of standard deviation moves, we had a relatively quiet day yesterday. We did have NASDAQ with a 1 standard deviation move yesterday, but none of the other markets made it quite to that. We still have to respect the fact that there's been a lot of standard deviation moves in the recent trading period, the last 2 weeks, but in the last couple days, relatively quiet. In fact, while we had significant bullish action, a big green candle across most charts yesterday. It was on very low volume. Europe had, in many cases, bank holidays yesterday, so participation was pretty thin with yesterday's action. Today will be probably more significant. Of course, it will still be influenced by the upcoming FOMC tomorrow. In terms of our regular daily report, not a lot of changes here today. We do still have phase 3. We're looking for higher highs and higher lows. And really important that we get that higher high. Definitely looking for that. We have been really in what can be probably best described as a compression, and compression can be measured as time in which the market price action basically just chops back and forth, back and forth, back and forth in a coiling action and eventually breaks out. Well, that can last for an extended amount of time. We've seen this a couple times in recent months. And this last breakout, really ticked us up, nicely when it finally occurred. So you have to be looking for that, ready for that move, and those opportunities can be significant opportunities for your trading or investing. And yet at the same time, you have to be very patient to wait for when does that finally occur. Our IBD status remains uptrend under pressure. GMI still a 3 out of 6. Active trader market posture weakly bullish. We have in our position sizing opinions a little bit of a mix. We have the long side portfolio exposure up to 50% based on this IBD status being uptrend under pressure, but on the volatility based, we still have the VIX within the acceptable window of 12 to 18, so full position sizing called for from that opinion. Market timing opinion. We are not overbought, we are not oversold. We are really, frankly, in the middle of the recent compression or range action, and the 1-day and 3-day outlook are neutral as a result. When you look at the current market posture, we are weak bulls across all 4 indices. So this is something of an improvement, but given the nature of recent price action in this ranging or compression zone, we'll see very often, a little bit of a bull move, then followed right away with give it all back kind of thing. So it's hard to put too much into this. Think of it like when you have moving averages that are sideways and they just wrap around each other. It is not a crossover signal when you have flat moving averages and they just flip-flopping back and forth. It's much the same with this market posture. Technically, these are called weak bulls, and certainly we had a nice big green candle yesterday. Even more impressive on the fact of that you had this extended overnight session, as it were, between the Friday session and the Sunday night session, and we gapped, in effect, way down, and yet recovered every bit of that with the price action yesterday. That, though, was all done with very low volume and without the participation of many of the markets from Europe and other places. So very easy to set this up as a bit of a fake and then to get drawn in and think that everything's all hunky-dory and bullish again, and just to see this thing wrap itself around and turn bearish, in a day or two. So be very careful with these current opinions. In terms of hedge warning status, we did leave this at threshold level 2. I was contemplating dropping this to a 1, and indeed if we see any significant follow through in the next day or two, it certainly would be called for to drop this to a 1. But there were a number of reasons that left me with a 2. One is that low volume yesterday. 2 is that we continue to have a significant number of distribution days. We continue to have a number of risk-off warnings being fired by our intermarket risk aversion indicators. There's just an awful lot of red here to be able to say that things are, really coming off in any kind of significant amount of risk. Option income strategies, no change from yesterday. The VIX is still inside the acceptable window, but we have all this significant number of standard deviation moves in the last 2 weeks. So at the very least, consider reduced position size. Cover call Same opinion as yesterday, neutral, calling for a 2-to-1 distribution between in the money and out of the money strikes, and probably best not to initiate new positions. Put selling, we are in a neutral stance, acceptable to sell puts against a core portfolio basket of stocks that you're willing to own in the position size that you are willing to own. And yet at the same time, caution should be exercised in establishing new positions. And indeed, I have to say that yesterday I took the opportunity to lighten the load, as it were, with many of the put-sell positions that I had, and took advantage of that big bullish move to take some profits, eliminate some downside risk in respect to the fact that we're still at hedge level 2. And if this thing should roll down and have significant weakness, I'll be very much appreciated to have taken those profits and reduced that downside exposure. In terms of yesterday's sector market postures, you see it with the big green candle yesterday, but we had a significant amount of improvement. Note though that transportation is still doing very poorly, and that certainly is a warning sign for the bulls. Dow theory would certainly espouse that transportation needs to be doing well if the broad market is going to be doing well. So that is definitely a warning. Healthcare, of course, has been very much of a hero for many months, and that one was also lagging in recent action. But again, a little bit of an asterisk by all this. We continue to have this ranging action affect these indicators as well, and when you have those flat moving average like lines, this can also give a lot of flip-flopping signals here that may not be as important as it is in a more trending style market. Utilities, though, seems to be putting in something of a recovery, some strong action put in by the utility sector, and then of course retail consistently has held up very well, and that probably is at this point the strongest sector. If you get down into the percent changes yesterday, you see energy continues to have significant volatility. As I said, utilities had a big day yesterday. But look at healthcare. Healthcare was up only 0.13 yesterday. So, financials, some of these sectors, not necessarily in yesterday was it just high beta versus low beta. Some of these sectors are definitely a little bit more inconsistent than we might like to have. In terms of specific industry groups, retail at the top, internet, healthcare, railroads, transportation actually is shown here as is number 5, and then biotech and the chemicals and pharmaceuticals following that. I mentioned those a little bit deeper down the list because if you break out the healthcare sector, you'll consistently see there's about 4 or 5 different healthcare industry groups that are all performing really quite well, and you might want to do a deeper dive into the healthcare sector, into the specific healthcare industry groups to see where that performance is coming from, and then focus your energies on that. As always, greatly appreciate your liking us on YouTube and sharing what you have found here. If you find this of value with your fellow friends and traders. Additional information available on the website, or you may email us at support@falconglobaltraders.com. Disclaimers as always, hit the pause button if you need more time to review this, and then we appreciate you each and every trading day at the Falcon Global Trading Community. You'll see us here once again tomorrow at about this same time in our market preview. Thank you.